Thank you for joining us for this edition of FedWatch. Today is Friday. Talking today about, from our perspective, we are still on track to see the Federal Reserve drop interest rates, between 75 and 150 basis points is the most probable range. It could be even more than that if things go more awry than we are anticipating in 2024. I don't see it being any less than 75 basis points based on the trends that are already in place. And some of those trends are these. U.S. total industrial production is officially in recession. The data trend is declining. It's a milder than normal decline, so that's consistent with that aspect of our forecast that we said this was going to be a mild downturn. In fact, the trajectory so far of the 12-month moving average descent is right in line with the 2015 through 2017, that whole cycle, and that's been one of our paradigm cycles. So we are on track for that, it looks like. So again, it's a good time to go back and think about how your business performed or your investments performed during the 15, 16, 17 era. Manufacturing continues to be in recession with the latest data. Last 3 months, manufacturing is down 1.7% from the year ago level. The data trend has been declining now for 12 months. That is a recession. And it too is in a milder than normal decline. It's close to the 15-16 decline that happened in manufacturing, slightly milder than that even, which is great. There was some interesting data put out by JP Morgan. One of our economists found this week that showed savings or liquidity really it amounted to by income strata. And the lower income stratas are already looking at liquidity levels lower than they were a year ago. And by mid-24, based on JP Morgan's analysis, even the 1%ers will be worse off than they were pre-pandemic from a liquidity / savings, deposits, money market funds perspective. That's important too. That fit in very nicely with our expectation that we're going to see some softening in retail sales. That retail sales, even in nominal dollars, will essentially be flat in 2024. So that was just a nice external piece of data that fit with our scenario or our vision for what's going on in 2024. Looking a little bit, let's stay in 2024 for a moment. There was some good news about 2024 in that corporate profits, non-financial corporate profits with capital adjustments, moved higher in the third quarter. Previously, we only had data through the second quarter. That data runs late. It's like GDP, runs a little bit later than GDP. And that posted a record high in the third quarter. And that is good. It had been quite concerning to us. The profitability was eroding. And if it continued to erode, we were concerned that it was going to cause even more hesitation in terms of capital commitments, CapEx, that sort of thing. And that was in our worry closet in terms of the slope for 2024. And when you load the financial sector back in, overall profitability is still running below year-ago levels. I think it's about 1.8% below year-ago levels. So that's improved from being down 2.2% because that also moved higher in the third quarter, but it did not fully recover, but at least it shifted into the right direction. So that's a bit of a relief from our perspective. Balance all that together, and we think we're pretty much on course for 2024, pretty much on course for interest rate decline in the coming year. Piece of good news looking a little bit beyond 2024 is that we are seeing some green shoots in the rates of change for housing. And if you read the news, you may have seen that single-family housing starts in November were very strong. Take that with a grain of salt, if you would. We've seen from some of our client data that if it was possible to be affected in November by warmer than normal temperatures and drier than normal temperatures, our clients benefited, and I think that's probably helping with the housing starts. They try and adjust for seasonality, but when it's unusually warm, unusually dry in some parts of the country, their models just aren't able to adjust for that. So it is good. I think a more realistic view is existing home sales. The rates of change there continue to improve. All the rates of change, 112, 312, 1212, they're all in phase A. And that's good. That means we're probably through the worst of the decline. But if you look at, say, the 1212 rate of change, it's at minus 21.6. So we have a long ways to go back to breaking even on this trend. And I looked at the 3-month moving average or total for existing home sales, and it's at its lowest level in 13 years. And we're not seeing mortgage applications come roaring back, even though mortgage rates have declined to their lowest level in like 5 months or so, down below 7%. So there is still that sluggishness in the housing market, but the rates of change going up is something to be looking forward to, because I think that's a reasonable tell for what to expect in 2025. And I'll bring this back to FedWatch because, well, I think we may see some interest rate decline in 2025. The Fed's own inflation forecast suggests that there is room. I think we're not going to get as much decline in 2025 as many people may be expecting by then. So we're telling our clients, look, you may want to avoid leveraging or rolling over an obligation until late 24, early 25, and we'll reassess then. But I don't think there's going to be that much more interest rate decline in 25. So I'd stay tuned or focused on early 2025 for probably the best time to be locking in rates again. On behalf of all of us at ITR, that is this FedWatch, and we wish you and your families the best holidays possible. Be safe, be with family, and enjoy yourselves. Thank you for watching this edition of FedWatch. We'll see you one more time this year.